Hey, I think we're ready to go. Actually, we're still a minute early, so we'll give everybody another minute or two, or give folks another minute or two to hop on. So you may want to have a pen and paper handy. If you're bored, you can scan either or both of the QR codes here over my shoulders. More information on this shoulder about our dual license reload program. I think that's the right one anyway. And then over here, if you or you have somebody you know is ready to apply for a mortgage or maybe wants to explore an FHA or VA IRRL streamline refi. We didn't even put that in the bullets, Jordan. I forgot to even include
Well,
FHA
yeah.
IRRL streamline refi, which is a
Earl,
mouthful.
Earl,
Earl,
Earl, Earl.
Earl. Well, that's another thing that we'll touch on as we go through here. Which it's now the top of the hour. We want to respect everyone's time and go ahead and get started. So welcome. I don't know. I cheekishly titled this FHA financing for dummies like me. So I'm still learning a lot of the ins and outs, the guidelines, the little nuances of many different financing programs and options, FHA being one of them. And so Jordan mentioned last week that he thought that this would be a great topic to do a deep dive on. We've touched
Done
on
one.
a number of these things over the
Yeah.
last year, let's say, on these info sessions. But things are always changing and evolving, and sometimes we forget or are reminded of different things. So I've got a nice little checklist or bullet point list of things we want to cover here about different ways that you can use FHA financing as a tool to help more buyers, so you can sell more homes. You can help more folks realize the dream of home ownership, the American dream of home ownership. So
And none the better to the most dynamic program out there, right?
there you go.
It's the most flexible, dynamic program ever made. Let me put it that way.
Well, since you started there, I think part of why you're saying that has to do with the pillars that we often talk about on these sessions. So let's talk about the three pillars and how that relates to qualifying for FHA financing.
So anytime you're qualifying a client, and I've said this many times on these info sessions, is we look at three main categories or three pillars, three legs to stand on: income, credit, assets. Assets wise, FHA has one of the lower down payment requirements. A lot of down payment assistance is also tied with FHA, so it can be as little as 0% down to the more standard 3.5% down to as high as 10% down requirements in certain situations.
Yep.
But overall, dynamically, if I'm comparing an FHA loan to a conventional loan, it's far cheaper, right? On the assets.
Yep.
Typically, normally. There are such certain situations where you might have a cheaper down payment on conventional loans, but for the most part, it's going to be an overall cheaper loan. Regards to income, it is the also the highest allowable on debt ratios, where FHA will go up to a 56% back-end ratio, 56.99 to be exact, which means more house payment, more debt they can hold when qualifying for a house, a higher price point when they're looking for a house, compared to, let's say conventional's 50%. It
Yep.
has one of the more a higher ratio on the income, requirements. And then the last is credit score. That goes down to a 500 credit score. I know that seems unrealistic, and a lot of people haven't done that, but just in the last 3 weeks, I've closed, three clients in the 520s to 550s. And a lot of people think that it's going to be some crazy cost to it. Just to give you an example on the cost compared to a let's say a 680 credit score borrower, I just have these off the top of my head because I've done them recently, I'll have a 680 credit score borrower in the low sixes, where I'll have a 520 in the low sevens. It's not that huge of a difference for a client, and 9 times out of 10. Do not discourage people from necessarily applying just because they have a lower credit score. FHA is always an option. Now, I like to expand on that because a lot of lenders will have overlays. Okay.
Right.
And it's unique in the scenario that you actually work with a retail lender, such as like a Cross Country or Wells Fargo or a Bank of America, that might do FHA loans. But a lot of times they have overlays where they won't go down to 500. Keep that in mind when you're talking to other lenders and they're telling you what programs are out there and FHA programs are out there. We are going to give you the base guideline, no overlays. It's exactly what FHA allows. I have over 200 banks we work with, me and Josh do. And
Yep.
a lot of those banks do have overlays and we won't go to those, but I have 5 that do not have any that we use. And we use those for lower credit score clients and things like that.
So I just want to reiterate a couple of things here. And by the way, we want this to be as interactive as possible. So if you have questions, you can put them in the webinar chat or you can put them in the Q&A box. We are happy to do this. These are intended to be interactive. I think they're more valuable if you have scenarios, if you have questions, etc. Some of you may have just learned something new and we're less than 5 minutes or about 5 minutes in. Okay. So to reiterate, clients can qualify for FHA financing at 500 plus. 500 to 579, they're going to have 10% down, but nonetheless, they could potentially qualify, right? Because there's 3 pillars involved here, right? 580 plus, they then are eligible, let's say, for 3.5% down. And for down payment assistance with Jordan, we have a great one that offers 5% down. So that not only could cover the 3.5, but some of the closing costs. At what score do they need to be to qualify for that?
I'm going to give you what the minimum is, then I'm going to give you what reality is. Okay. Because there's a difference. Reality is we probably need a closer to a 660 for the systems to say yes. Okay. When you're doing, 100% LTV. The minimum is 580 with that company specifically.
Yep.
Okay. So could we do a manual underwrite at a 580 credit score and get it through, which is a little more requirements and a little more hoops to jump through? Yes, you could, but it puts you in a very strict box at that credit score, where a 660 would open you up to normal financing, normal guidelines, roughly.
Yeah. Nicole chiming in already, which we appreciate, is giving people with those low scores going to land us in a situation where we get a bunch of foreclosures later on. I think that's a little bit, Jordan, I have some thoughts, I'm sure you do, but that also is, I don't know.
I would just leave it at this.
Question.
Yeah, it is a subjective question, but just to kind of touch on it just a tiny bit is there are higher requirements for those. So it's not like you can max out debt to income ratios, or it's a minimum of 10% down. A lot of times it's not and a lot of times you have to have a cosigner as well. Like I'm doing one right now that has a cosigner with a 700. The main borrower is 700. Her cosigner is 557. Right. So it's usually multiple people are liable for this loan, so you don't see them as often foreclosed. It's a little more stricter.
And credit score alone does not necessarily reflect the total financial picture of a borrower. For example, this is a little bit off topic, but not really. I was chatting literally 5 minutes before going live here. I was chatting with a borrower that we're trying to help. She owns 37 properties, but her credit score is a little low right now because of hard inquiries and some other weird
debt load, credit card debt loads. I mean, there's a lot of things.
So financially, I mean, she has literally over $1 million, well over $1 million of equity, and financially very strong, other than that one, piece of her financial picture isn't let's call it ideal or optimal right this second. Go ahead, Jordan.
The other thing that FHA will look at is longevity. A lot of times, I'll give you an example of longevity. Two clients. I got a client that has owned previous real estate with a 550 credit score, right? Owned previous real estate and never made a late payment or anything on it, but they maybe made a late payment on a car or a credit card and their credit score is low. And then someone with a 660 credit score that's only had 2 credit cards and never had a card, and the credit card's only 2 years old. A lot of times I won't get an approval with the 660, but I would with the 550. You see what I'm saying? They take more into account than just the score itself. Just to kind of reiterate it, they look at the entire credit report and analyze a lot deeper than just that. So when we're guiding people and helping them, that'll get into kind of my next, on credit direction or whatever. We do give clients advice on how to get their credit up. That'll be one of the things we talk about is longevities. How can we populate longevity to get their score higher, or maybe get the system to say yes?
Yeah. Shalisha, I think I'm saying that right. I hope. And if not, I'm sorry. Is the 5% DPA restricted by state?
No. I can look at Click and Close, but I think they're in like Click and Close is the DPA program. And I think they're in like 45 states. It'd be
They're
rare
in the
if you can't.
majority.
Yeah, in the majority. I'd have to double check what state. So they're only restricted by what they're allowed to lend in. Let me put it that way. But I haven't found one they're not allowed to lend in yet. And we're in like 22, something like that.
And one of the reasons why Jordan really likes that program is there are literally hundreds, if not thousands, of down payment assistance programs, grants, loans, etc. The problem is, in many cases, there are, it might be restricted to just this particular area or this specific county or whatever those may be. And so Jordan tries to find programs that are the most universally available, so that when we're working together and you're presenting that as an option to a borrower, we have the greatest likelihood that they might qualify or that it might be available to them.
Jordan, and it doesn't have any income restrictions. A lot of those DPA programs, you got to be a first-time home buyer, and you can't make too much money, but you can't make too little money. It's they start restricting them a lot, and I like that program specifically because it doesn't restrict at all. For the most part, just by the states that they're licensed in. That's it.
Yep. Okay. All right. Where shall we pivot to next? Or we talk about maybe
I would like double FHA loans. I think that's a good topic. I think a lot of people don't realize you can have more than one. I think the common misconception is you can only have one FHA home loan. And there are about 4 or 5 different situations would allow you to have more. Working the system, let me put it that way. Okay. So I'll give you an example, and I've done this
legally and ethically. Okay.
Yes, legally and ethically. Yes.
Yeah.
But still working the system. But let's give you an example, right? Let's say you're engaged. Let's say I'm engaged. Me and my wife, my fiance wants to go and buy a house. We decide to go and buy a duplex. Okay, live in one side. That would just be a standard 3.5% down. As long as our credit score is above a 580, we can move into that and rent the other side out for a year. We get married in that year. We also decide we want to have a baby. Okay, my wife's pregnant. I'm increasing my number of dependents, and that would be an allowable reason to move and obtain another FHA loan without having to refinance your first one. Okay. So that would be an example.
What might we do with the first one then? I mean, it's kind of obvious, but
rent it. I mean, we just keep it and rent it, or do whatever you want with it. I mean, at the end of the day, as long as you live there for a year, you can move on and move on to something.
As long as you've been in it for a year and you have a legitimate reason why.
Usually, like I've done it where mom has come to live with us, right? His mom is getting older. They come to live with us, and my number of dependents increased. So the rule itself is number of dependents decreased, and you also need a 25% equity position in the first house if it's less than 100 miles away. Okay. If it's more than 100 miles away, then you won't have to have that equity position.
Okay.
Okay. So that's been really good. If we look at from 2020 to, or not even 2020, 2019, let's say we had homes bought in 2019, they currently have an FHA loan, they want to keep it, they're trying to figure it out. They probably do have that equity position, to be honest. I mean, homes have increased quite a bit. So right now it's kind of a perfect storm for people that bought their home from 2016 to really 2019 to see those equity positions without really trying too hard. And then increase in dependent size, right? Another kid, whatever, we don't have enough space, you can move on.
Yep.
Second reason would be job change. Obviously, you can, if as long as it's over 100 miles away, you can, if you're transferring a job, you can have another FHA loan. Okay.
Okay.
Separation. Me and my wife are separating. Okay. And key word is separating, not a divorce, separation. Okay. Me and my wife are separating. You can go and one person can stay, right, in the current houses, or I guess it's not necessarily even separating. It's, let's say you co-sign with, you and mom co-sign together. You guys are both living in the house. You and your brother are living in the same house or whatever. You can go move if you separate and one is staying and the other one's going. That other person can go ahead and get another FHA loan. Okay.
Okay.
And then the last but not least is you can co-sign for as many as you want. Okay. I've done this a lot with big families, tight-knit families. I have one investor slash brother, really, really good brother, that had 8 siblings and he bought 8 quadplexes, is literally what he did. And he bought each one of them a quadplex. They went into it together. They live in one side and they went and bought a bunch of, quadplexes. That is something that is allowable as long as that person is truly living in the property. You can't just go and co-sign for people and then no one ever move into it or anything like that. It has to be the intention of them buying it as a primary residence.
Yeah.
Okay. It literally says in the guideline, it can't be used for 100% investment purposes.
Yeah.
Okay.
All right. So hopefully your creative juices are flowing here. Those of you watching this, whether you're watching live or after the fact, which by the way, if you hopped on late, just so you know, immediately after we're done, you can check out the replay from start to finish on demand after we are wrapped up. Where should we
I talk
pivot
about
to?
the different programs a little bit. I know we
Yeah.
touched on DPAs a little bit.
Yep.
But DPAs obviously is a no-brainer, right? Is like that. That's very often DPAs are tied with FHA loans a lot more than conventional. And then $100 down program. FHA does allow $100 down. They have a program that is $100 down that are still DPAs typically will have higher interest rates, higher fees, things like that. But the $100 down program is specifically for HUD homes.
Yep.
And you can go in and put $100 down and buy that HUD home. Now finding those HUD homes is the challenge more than anything.
Sure. And where might folks, like, where does one find those?
I think it's HUD.gov. I have to look at the website itself. But I think
The
it's
one that I
HUD.gov.
used to use is HUDhomestore.com.
Yeah,
But what
HUD
you're
Home
saying
Store
is
is good.
any HUD homes,
HUD foreclosure, yes.
HUD foreclosure homes, a owner occupant could, if they qualify for FHA, they could buy with 100 down.
Yeah, it's just $100 down is the requirement.
Theoretically. Okay.
Okay. There is a
Beautiful.
203B escrow. Okay, that's for less than $5,000 worth of work. Okay, these are also on HUD homes since we're on the topic. Okay, so HUD homes do not and you could tie it with even the $100 down, but let's say, a lot of HUD foreclosures, you have a little bit of work, need to be done to them, right?
Yeah.
They're not just they're not completely, done up, right? They might need a little, little cosmetic, a little loving on them. And there's something called 203B escrow. That's a HUD allows an escrow up to $5,000. And it allows up to $5,000 to repair that stuff after closing, because HUD's not going to let you touch the property. A lot of times they won't even let you turn on they'll short time, turn on the utilities for a short time, but for the most part, they're not going to let you go in and put work in to make it pass FHA inspections for the most part. So keep that in mind when you're looking at those. Wes asks, yes, it does, Jacqueline. Yeah, it gets added to it and it's escrowed for it.
Well, hold
It's
on.
usually bid
So
out.
does the 5,000 get added onto the loan? That was the question. So does
Yeah,
the amount get,
yeah.
Yep.
It's like a mini renovation loan. It's just to basically help. What they found is when you're trying to sell HUD homes and doing $100 down HUD homes, there's little cosmetic things that has to pass, FHA appraisals, and the
Yeah.
appraiser will call it out. It's to fix those items. It's to get those items fixed. Okay. And it just depends on that money. It's a lot of times they'll escrow for it and they'll just pay it, pay it outside of closing to the contractors after the fact. So allow you to close on it, where traditionally you can't close on loans that have FHA appraisal requirements. Okay. So let's say I'm doing a normal FHA home loan and it comes back with peeling paint and I have to peel that paint. Unless there's a reason that you physically cannot do it, such as we just had a big cold snap, right? You can't paint in this weather. That would be the only reason that they'll allow you to escrow. Same concept when you're buying a HUD appraisal. Even if it's nice out, they still won't let you touch the property. So they'll escrow for those tiny items. But it's up to $5,000. Anything past $5,000, you get into actual renovation loans.
So a couple of folks noting that there's a bidding process on HUD homes. Absolutely. Owner occupants have first priority. So owner occupants, folks that are going to use it as a primary residence, they get first crack, let's say. But it still could be a bidding war amongst owner occupant interested buyers. But like Jordan mentioned, a lot of times these places need work, and if you're the one that is able to point them in the right direction, connect them with us, let's say, or with someone that has experience with a 203B or a 203K, that can help them renovate the property where the others may cross it off because they don't have the money to do the renovations, or they're not being consulted or educated about those options. That may lead you to be the winner in that scenario versus those that you might be competing against.
Wes asked, can you use the 203B with a normal FHA loan? So a 203B, the actual loan, 203B is a normal FHA loan. The escrow part, it's just meaning you're escrowing for repairs. The answer is no, if it's not a HUD home. Okay, it's only allowed on HUD homes. You can escrow in certain situations. Got to be a very certain situation, such as right now where I live, it's 1 degree, and then no one can paint. If someone called out peeling paint, we would escrow for it 1.5 times for the $150 bid to paint or whatever it is, and then we would do it after when the weather warms up. Okay.
Which, by the way, I will tell you this: you need to make sure you're working with a good lender. I had a transaction, maybe even 2, where my lender didn't know that was a viable reason to escrow the repairs, and it jacked up our settlement. It jacked up our closing unnecessarily. So knowing the guidelines, making sure that you're working with a lender partner, a mortgage professional who knows the guidelines inside and out, can save yourself a lot of frustration and heartache and unnecessary stress. That's one example, but many scenarios.
I think, and I'm going to get on a little bit preachy here and then we're going to move on. But I think a lot of times mortgage lenders forget that they're here to help the settlement, not just clear guidelines, clear conditions. There is a whole process of movers, closing dates, settlement, title companies, that if we move a date in general, it usually means that I'm asking you guys to do a lot of work, utilities, you name it. And clients get very stressed out if you have to move a closing, a week before closing or whatever, and they got movers, utilities set up and stuff like that, and they got to call these places back. I try to take that into account. And I try to teach loan officers to take that into account. You are part of this settlement and you're a part of moving all those dominoes when that stuff happens. So knowing the guidelines are super important. Josh is correct. Which gets
Wes,
us, go
and
ahead.
so one thing I just wanted, Wes had a follow up on the on demand. Just those that are wondering, the on demand replay will be available immediately after at the exact same link that got you here. It will also be added to our YouTube channel, Wake Up Real Estate, and at wakeup.realestate. Jordan will also be posting on his socials. So we'll make it as easy as possible for you to find it. And if for some reason you can't, our contact information is in the chat, and you probably got an email invite or a social media invite to come here. One way or another, we will get you the full replay if you hopped on late or you just want to go through it a couple of times, because there's a lot of good, meaty information in here.
Let's jump into the next product.
Yeah.
203Ks. This is not a fun product for most mortgage originators. When I got into the business 10 years ago, I asked my mentor, what is the hardest product to do? And I will do that to differentiate myself. And that is an FHA 203K loan. Okay, that is the renovation loan.
Yeah.
So I used to do 5 or 6 of these a month. They are not of the faint of heart, but I don't want to dissuade you, because there are situations, especially in a market like this, where 203Ks are a great addition for clients to get into homes that might not be selling, right? For XYZ reasons. Could be we need something fixed, or and it's just turning people off. Where a 203K loan is, there's 2 types, okay? There's one that's less than 30,000. I say it's less than 30. It's really less than 33, but after reserves and stuff, I tell people your bid's got to be less than 30 grand. So it's less than $30,000 work, which is called a 203K limited 203K loan. Okay. It's a much shorter process, less cost in general. And it allows that homeowner to get in, make a couple repairs, and do what they need to do. Then you have the full-blown 203K. Okay. We're not going to go too much in detail on these, but full-blown 203K is a lot more in cost. And you can do a ton of stuff. You can make additions to your house. And it's a good product for that very specific buyer. What I tell people a lot of times, or my clients a lot of times, is I try to set the expectations up front and very firmly up front when we're doing 2 or 3K loans. And the biggest expectation I'll say is contractors. They are what's going to slow you down. Okay. They are the only thing that's really going to stop you. And that's what the biggest frustration is. I do not tell my buyers that it's the realtor's responsibility or my responsibility to wrangle the contractors for your loan. I make it the client's responsibility. It ends up being way too much work for the real estate agent and way too much work for us, and putting way too much pressure on us to get that home loan done without making them do that work. They're the ones that get to choose them. They're the ones that get them bidded out. They're the ones that typically handle that. Okay.
Yeah.
But that's only that's as deep as I'll go on that. That's probably a whole session that we probably need to do over that one, because I am so well versed in it. But
And I'll give you one real world example of this in practice, or an opportunity, taking a home that's not selling and having being able to win that home without competing, right? Because let's face it, most all of you listening here are still in an extremely low inventory market. So I had clients that Cosette, our buyer specialist, showed a house to Saturday, and I followed up with them this morning. Hey, what'd you think, etc. And they said, well, we really love the location, we love everything about it, but it just needs a lot of work, and at that price, it doesn't really make sense. So I follow up with the listing agent. Agent says, you know what? I actually had a lengthy conversation with the home seller, and they realize that it needs a lot of work, and they're open to offers and negotiating. And now later this afternoon, they're going to be chatting with Maria on our team, and that's going to be one of the options that is going to be explored. Hey, listen, if you love this place and we got to figure out how we can renovate it, bring it up to your standards. Here's a way that we could potentially do that. And that home is sitting because of that. It's priced as though it is renovated. It's not renovated, But if we're the ones that can get it at a price that makes sense for the buyers and do the renovations, you know, voila, we've got
Obtained a
ourselves.
transaction. Yeah.
Exactly. Yep. Laurie says, can an investor use a 203K loan?
No, it's only for primary residence. Now,
Yes.
there are other loans out there, fix and flip, all kinds of stuff for investors that we can do. They're actually easier in the terms of paperwork and things like that, and
Yep.
contractors that you could use.
Yep.
But they usually require higher credit scores and sometimes in such situations, usually higher down payments. So the 203K
Laurie,
will be
if you
3.5% down.
yeah, if you or anyone on here has scenarios like that you'd like to get pricing on, I've got a templated email that just has questions that we need, and we can go and shop for those options for you, or if you have a client. Not the topic for today, but certainly reach out and let's see if we can help and give us an opportunity to win that business. We've got a ton of great options as far as those goes.
Mm-hmm.
Okay, Jordan, how about I hinted at this at the beginning. Can we talk a little bit about FHA IRRL streamline refis?
Yeah, so this is my favorite loan of all time, is Earl's. And this is mainly for really just to I think for your knowledge base more than anything that is out there. And I'm going to use this as an example. Okay, as usually an example of why this is important in this market currently. Okay. Um, you would I would assume a lot of you are getting objections on rates still to a certain degree when you're talking to clients.
Yep.
Okay. The Fed has announced that rates are going to be cut 6 times this year. Okay.
So that's good news.
Yeah, that's good news. And what that means is, hey, it's your interest rate today is going to be most likely quite a bit less than in the next 12 months, right? And then also combining that with an election year. Election years usually always promote lower interest rates. They want the economy, feeling good going into that voting season, per se. And so it's a good chance that rates are probably going to be about 1% less in the next 12 months. Now, I wouldn't necessarily, I would say, this is my personal opinion, okay? I don't know in all of your guys' markets, but I would say the competition right now is a lot less than it was in 2020 or 2021, where people were offering $40,000 over asking price and everything was going cash or conventional. I'm seeing a lot more FHA buyers, and that just means that there's not as much, not that inventory isn't low and that there's not demand. I think there's still demand and full asking price, and I think it's still hard to get seller concessions, but I do think it's a better time to try to get into property right now. But it might not be in the next 12 months. So when I'm talking to clients and I'm advising them, I'm not advising them just on this loan. Okay. I'm advising them on a whole 30-year plan. How do we get them into the best possible and possible? Right now is a good time to buy because the demand isn't as high, right? We don't have people offering $40,000 over. And that's where an Earl Streamline comes in later on. We buy today, buy into the property today, get it at, a low 6 or a high 5, whatever the interest rate is. Okay. And then we talked to them about there's a program called a Streamline Earl. It's offered on VA and FHA loans. It's where they can just drop the interest rate after 210 days, as long as it's more than 0.5%. So what I mean by that is there is no appraisal, there is no income check, right? There is just a credit check. And besides that, they just provide their property taxes, their insurance on the home, their driver's license, and that's really it. There's not any other paperwork. And what it's called a streamline refinance. I can close these in 7 days, literally. A full home loan in 7 days. That's the most legally allowed, by the way. That's the least legally allowed. Is you got 3 days for your LE, you got 1 day for your lock, and then you got 3 days for your closing disclosure. So 7 days is the minimum. But when you're talking to clients and explaining, hey, what is the market like? Explaining, hey, the interest rates are going to be cut over the next 6 months. And then they say, well, I'll just wait. Well, it's probably not going to be a good idea to wait because as interest rates drop, the demand is going to increase. When spring comes, things like that, you're going to see see a higher demand on property and people trying to get into property. So it's just explaining to them how the market is and what your professional opinion on what it should be. And mine is they should buy right now and they should do a stream on or later because rates are going to be dropping. So
So a couple of things on that. If you're curious, IRRL is interest rate reduction refinance loan. If you care, but that's what it is. But the thing that I want to emphasize is the idea that Jordan shared, being you can't retroactively renegotiate the price you paid for the house, but you can renegotiate, quote unquote, the interest rate you're paying. And so if you're having that conversation and you're running into that objection, that's a great way to overcome and get people to be more comfortable moving forward. Would you like to wait for 6 months and be competing against, I don't know, double, triple, quadruple the amount of qualified buyers for the same property? Or get out there today, find the home that makes sense, negotiate the best deal you can now, and then in 210 days, if the rates have come down a bunch or when they've come down a bunch, we can go and figure it out from there.
I'll have people every once in a while that they'll object again and say, oh, well, what if the demand doesn't go up? And I said, well, if the interest rates go to 3%, do you want to buy? And they go, yes. And I'm like, okay, there you go. So it's up to you. It's up to you at the end of the day. Can a buyer buy their rate down with FHA? Yes, I have someone locked in at a 4.875 right now. With that being said, I would not advise it. Okay, it's probably a little bit longer conversation we should have with that, but I wouldn't advise buying the interest rate down because you won't make your money back before interest rates drop over the next 12 months. I would a lot of times when I'm advising clients on whether or not a buy down should be implemented, it's a math calculation at the end of the day, right?
Yeah.
Is how many months. Okay, so if you're saving, let's say it costs you $5,000 to buy down that interest rate of extra closing costs. That's what a buy down is. It's extra closing costs to buy down that interest rate.
Right.
Let's say it's $5,000. Well, let's say their payment changes $125 a month, which gets them in the payment range they want. But let's math it out. 5,000 divided by 125 is X amount of months they would have until they break even. Okay. Everything after that would be profit for them, and that's would be savings, right? So it could be over 30 years, be tens of thousands of dollars savings, assuming interest rates aren't dropping. Everything is telling us right now that interest rates are going to drop over this next 6 months, so to a year. So I wouldn't recommend buying down the interest rate, because you're not going to make your money back fast enough. You're not going to break even. You'll end up losing money.
Yeah. It's funny that you mentioned, I just got an email in our inbox by one of our lenders about a temporary rate buy down. They're great marketing tools. In most cases, they're not the best solution for the client.
Yeah. It's your way in. And I think a lot of times when you just, if you're able to educate the client and not assert your authority, but our authority figure on the subject, a professional, a lot of times they'll decide not to do a buy down. But I'm not going to, I'm going to educate them, give them the loan options, and then I'm going to tell them at the end of the day, we can still buy down your interest rate if you want to, right? I'm just advising you against it. I don't think it's something that you should do.
Yep.
Okay.
Ultimately, it's always the client's decision. Our job is just to help them, as best we can to make the best decision for themselves. And it's ultimately, their call in the end. No question.
Hence, we got someone at 4.875 right now.
Exactly.
So they are paying $12,000 for that buy down, by the way.
Okay.
So it is very expensive buy down on a $300,000 house. So
yeah. What haven't we covered yet?
We had a couple questions for Wes
list?
on the
Good.
Earls. A couple Earl questions. Can you do those before the 6-month waiting period? No, you have to wait 210 days. And you could do one every 210 days. My client is Earl today. Can they do another in 210 days? Yeah, absolutely, they could. They could do multiple, as long as it's over a 0.5% drop in interest rate. It has to drop at least a 0.5%. There's a term
Because
called,
that's the line that is sort of drawn in the sand that there's a net tangible benefit, right?
yeah,
Like otherwise
there's
it's like,
something called churning, which back in the day is a very a real thing that would happen very often. Now there's rules and regulations around it, is continuing to refi the same person over and over again so we
right,
could make money. That doesn't really exist anymore. There has to be a net tangible benefit that puts them in a better position each time.
exactly.
So 210
And,
days
and
minimum.
and here's what I would, I've talked about this VA and FHA Earls a couple times over the last couple weeks because I believe, I strongly believe you have a fiduciary responsibility. If you helped a client with a VA or FHA loan purchase a home in the last 6, 12, 18, 24 months, and their rate is north of Jordan 6.5,
Yeah, 6.5. I mean,
north of six and a
we
half,
quoted someone on VA 5.49
it is your
yesterday. So.
fiduciary responsibility to make them aware that this is something they available to them because most folks won't know that. It is a wonderful way for you to bring them good news, even if it doesn't tangibly benefit you. Though, if you were dual licensed, but you can scan that QR code to find out why you might want to be, it could financially tangibly benefit you. But regardless, it's your fiduciary responsibility to do so. And we have an FHA Earl in process now. We actually have a cash out VA. It's not an Earl, but it started as, we kind of started as exploring maybe an Earl, but he determined he wanted some cash out. And I have another Frank Murphy, a great agent in North Carolina. Ryan on our team just connected the two of us because he has, and I didn't even tell Jordan this yet, he's got a client she purchased. Her VA is in the 7s, I think. Well, we absolutely want to talk about getting her
Yeah,
into an Earl.
dropping.
That's VA, not FHA, but it's a similar thing. Is there a cost for the Earl? Jacqueline asks.
Wes, so what is the way? Let me start with Wes first, and then because that's an easy way. So why do we wait 210 days? It's a guideline for both products, VA and FHA. You have to wait 210 days.
Yep.
And then they asked, how would we apply? You'd apply just like any other loan. You just contact us, and we'd apply. We just don't gather income docs we don't gather income docs or anything like that. It's just based off credit. Is there a cost to the Earl? Yes, there is a cost. The costs are less than a normal loan just because you're not going to be doing a full refinance. There's no appraisal fees or anything like that. Typically, processing fees are a little bit cheaper. But you're going to have title fees and those things, but you could typically roll those into the loan. It just depends on your state mostly. I would say my rule of thumb is about $2,000, $2,500 maybe. But again, it's got to offset itself, right? It's got to make sense. The net tangible benefit, there's a calculation with this, and the net tangible benefit has to be there even depending on what the cost is. Yeah. So typically 9 times out of 10, there's always a net tangible benefit because over the long run, reducing 0.5% is $40,000-$50,000 over the long run. Right. Do you have to reestablish escrows? Yeah, unless you're going with the exact same company, they're just offering a recast, which is not very common. And you got to kind of watch out for interest rates on those. There's a little bit on those. Recasts are different than Earls. You would have to reestablish escrows accounts. So depending on what those are, now you get your old escrow back in 6 weeks. So typically you roll those on and you get them right back.
And there's a little bit of timing, there's a way that you can kind of finagle when the settlement, there's a way to minimize or optimize that whole process. And that's, again, a good reason to have a very well-educated, experienced mortgage professional on your side, like Jordan. Some other I would say quick hitters that I had in the bullets, Jordan.
Okay.
we talked about mortgage insurance, the difference between conventional and FHA. There was a change that happened recently that to the guidelines that has made FHA. Well, Jordan, you go ahead. I mean, at least
Mortgage
from the
insurance,
borrower's
yeah.
perspective.
So there isn't really a situation now, even with 20% down, that conventional will actually beat an FHA home loan. There's many instances I've had where people are getting quoted to conventional and they come to me and they'll have a 780 credit score with 20% down, and I'd be like, why are you going conventional? What had someone presented the option of FHA to you and compared it side by side? I'll give you an example. Mortgage insurance on FHA standard home loan is 0.55 with the 3.5, less than 10% down is 0.55. Mortgage insurance on FHA with 10% down is 0.5. Okay. Conventional is based off credit score. So anybody that has a lower mid credit score, maybe it's 600 to 680, 690, they're definitely going to beat conventional. But even at 20% down where they're getting out of mortgage insurance, a lot of times the interest rate plus mortgage insurance is still less than the interest rate on conventional. And I proved it time and time again, where I've had, scenarios with clients, and I would just write them up side by side, and I'll say, hey, here are your two options. This is what the monthly payment would be, this one. This is what the monthly payment of this one. And this is what I tell clients every time. There are two most important things to me constantly when I'm advising them on a mortgage is, what is my payment? What is my cash to close at the end of the day? Typically 9 times out of 10, unless you're doing something funky, but 9 times out of 10, those two things will directly affect how much you're paying in interest over the long run.
Yeah.
How much that cost of that loan is. And we look at those two things, and then I explain to them side by side, and I say, hey, this is what that looks like. But that cut in mortgage insurance has really made it to where FHA is a very, very solid loan. I personally would get an FHA loan. I would recommend people that are even on conventional and don't have mortgage insurance and have 40% equity in their home. I still would recommend, if they have a higher interest rate and they bought in the last, 2 years, really, to look at FHA when they're doing it. And it also allows you to open up to IRRRLs. So yeah, in the long run.
Just another benefit, no doubt about it. Mona has a great question here. So Mona asks, when a buyer client applies for an FHA loan, does that application have a number that can be shared with another lender if they decide to work with another lender? Or does that buyer client need to apply with the new lender and have a new application number? Just wondering on impact on their credit when applying with different lenders. So there's a lot to unpack in that question. Yeah. So Jordan, go ahead.
Let me start with number one is really that it's wondering on the impact of their credit. I don't know if a lot of you guys know me personally, but I did do a lot of credit repair in my past. Okay. There are rules surrounding this with mortgages. Okay. Yeah. Those rules are 14 days. You can shop as much as you want. Number one. Okay. You can ding your credit as many times you want with mortgages for 14 days. Okay. So if you have someone shopping, because this is the biggest purchase of their life, that's what I tell clients all the time. And we're a broker, and we have over 200 lenders. We're not going to hit their credit 200 times. We're going to hit their credit once. But even with us shopping those, I still tell my clients, go ahead and shop it. They're not going to typically beat me on any retail lender. So I'm not really worried about it. So I give them a closing cost worksheet. They can go and shop. But to answer you, no, it's not going to impact them. To answer your question it's FHA isn't, you're not applying for an FHA loan and then it's like, hey, now you got to pick the lender that you're working with. We are backing a loan with FHA. We are licensed to give out FHA loans. So when you're applying, you apply with each person individually. You don't go and seek the FHA loan first and then kind of pick and choose the lender. It's the opposite way around. It's you go to a lender, you apply, you get quoted, and then if you want to shop around, you got to go apply with other lenders.
2 more topics, bullets that I had in here that I want to make sure that we don't, I want to make sure that we cover everything that we promised. FHA and bankruptcies. Can you talk about that?
It's a lot shorter. it's a lot shorter time frame with FHA. There are situations where I've had people claim bankruptcies. Well, let's back up. It depends on the type first. Okay, Chapter 13 versus Chapter 7. And Chapter 7 basically wipes out all your debt, no monthly payments. Chapter 13 is you're paying back the debt. It's just a minimized, negotiated amount, basically. And Chapter 13, if you've made perfect payments for the first year, you can be in the middle of a bankruptcy and still get a home loan.
There you
Okay.
go.
And in the 13, the 7, the earliest time is 1 year. The standard is 2 years after bankruptcy. Conventional is twice that time.
Yep.
Okay, keep that in mind. So conventional is 4 years minimum. But I've gotten away with Chapter 7s with extenuating circumstances of 1 year after bankruptcy. Deaths, right? Very sad stuff, kind of things like that, where you're trying to help a single mother now, try and refinance their home or get them in a situation that's better. Those are situations that can come up every once in a while and get into, but typically extenuating circumstances are not approved ever. I've done 2 in 11, almost 11 years. So it's very hard to get through, and the standard is 2 years, which is still half the time than conventional. So it's a much shorter time on bankruptcies and foreclosures than where a foreclosure with conventional can take as long as 7 years to be able to buy
Yeah.
a home again.
Here's why this is important for you to understand. If you have a borrower or a client who says, well, I got denied, it may be because they were trying to get a conventional and they, you've got to ask good questions, I guess is the point, right? Because sometimes there's a simple and easy solution. Not always, but sometimes, many times there is. And it's just because either you or the lender that had worked with them didn't ask enough good questions, didn't dig deep
I,
enough.
I don't like to say negative things about other lenders very often because it's my job and that's what I've done a long time. I've done this a long time, but I
Yeah.
would say if it gets a little wonky and hard, a lot of people give up
Yeah.
a lot of times,
Yeah.
and you want to make sure you exhaust all options with that.
Yeah.
But bankruptcies they're one of those things. It's really cut and dry a lot of times with Chapter 7. It's 2 years from discharge. You can get a lot of people approved from there. And then I think Danielle asked again.
Yeah, to repeat what you said about Chapter 13 and when you can get
So
repeat what you said about the differences, I guess, between
Chapter 13,
7 and
yeah,
13.
Chapter 13 is a monthly payment. They all have a monthly payment. They got to
Okay.
qualify with that monthly payment on the Chapter 13. As long as they made the last 12 months on time, they typically can qualify. They do need trustees' approval, but I've never gotten denied from a trustee for someone to have home ownership because it's not a bad asset, right? It's an asset to them. It's something that they're actually saving money each month and would have equity and something that they could use for the future, right? So I've never had a trustee not approve it, but it's 1 year of perfect payments. So let's say your Chapter 13 is 5 years long. They got to be 1 year in. I would say the norm to get an AUS accept is 2 years from that when that's starting, but only the last 12 months have to be paid on time.
Yeah.
Okay.
Okay.
So, but with that being said, it's a great product. I've done many home loans with people in the middle of Chapter 13 bankruptcies because they will wait. I'm telling them, do not wait. Do not wait at all. Don't wait the 5 years because it's harder the moment they get out of it because it moves forward on their credit. If you know it, credit is more of a like what's recent events that are happening. And when they get out of a bankruptcy, it gets statused a certain way and it brings that forward. And then all of a sudden they're hard to qualify again. I know it seems weird because they just paid off that bankruptcy, but catching people before they're out of bankruptcy is better on Chapter 13s than waiting right after.
Yeah. And there was wanting a clarification or maybe reiterating the window of time that you can shop without having. You had mentioned 14. This person thought it was 30. So let's just reiterate that point because it is, those days matter.
Mm-hmm. And Wes is right. If they do own a current home, that's more of a refinance thing, but they could buy out of that 13. They could purchase out of it. It's not required though. So Anything else? I think that's it.
Well, no, so
Any
I
other
was
bullet
saying,
points?
Jordan, can you reiterate the 14-day window? Someone had thought it was a 30-day window for.
I'm pretty sure it updated. I think it used to be 30 days. I'm pretty sure it updated. I might be, I don't check. I tell clients 14. I mean, I tell clients it's 14. They can shop as much as they want. And try to get it done. Um, don't lollygag. Let me put it that way. If you're gonna shop. Get as many applications out there if you want to shop around. But I make mine very easy. When I have clients shop with me, I just give them a closing cost worksheet and I say take it to another lender. And say, hey, give me a closing cost worksheet beating this kind of thing. I make that very easy for them to do, and I think transparency is super important because it makes them feel comfortable. It's less me trying to hide them when I give out a full worksheet and say, hey, go for it. It's a lot of lenders will give out a pre-approval letter and won't even tell them the interest rate, that kind of stuff.
One last topic that I want to hit on briefly is FHA assumable.
This is a great product, by the way, to sell. It's difficult to get through, but there's
Yes.
creative ways to get to do it. This actually provides zero value for me and Josh. So this is a
Yes.
real takeaway for you guys. The assumable mortgages are done through the current servicer. They're not
Right.
done through us. Okay. So you wouldn't contact us to do an assumable mortgage. But it is something that is out there and it's something that you guys can sell on your listings, right? Post on your listing. Let's say you have a client that has an FHA mortgage, and I'll give an example because I'm actually in the process of assuming a loan myself. I'm in the process of buying a house and I'm assuming a loan. I'm getting that house at a 2.99% interest rate. They bought it in 2020. Okay. And there's for sale by owning it, and I'm buying it for what they bought it for. Okay. Same price, just because he doesn't have any realtors on it or anything. And he's kind of in a pickle to move. Not necessarily a pickle, but he wants to move.
Yeah.
And so we negotiated and got to a price where I'm essentially buying it for what he bought it for in 2020. But I'm working with their lender, okay, their direct lender, to assume and take over that mortgage. In the normal situation, okay, I got lucky because I'm buying it for what he bought it for. They usually have a lot of equity, especially when they bought it for a couple years ago. And you got to be able to buy out of that equity. You can do that with second mortgages, depending on your credit score. We can do a second on it, throw a second on it to buy the difference of that equity out, but you still have to qualify traditionally for that home loan. So I'm still going to have to go through the process, still going to have to go through the process of getting qualified. But at the end of the day, I got lucky in my situation. Most people have very, very vast amounts of equity, and second mortgages only go up to a certain amount. A lot of times that max is 90% with a really good credit score. So that means you need like 10% down, right?
Yeah.
So, but maybe you're buying from a family member. Maybe you're taking over a family member's home loan. Maybe it is, and you're facilitating it, whatever it is. And they're purchasing that house. They can just take it right over.
Beautiful. So this is a wonderful jumping off point to start wrapping up, which is Danielle asking, how can we work with you as a lender? I'm with EXP. And so I've got my information on the screen. I've got Jordan's information on the screen. I've got the contact information in the chat. We would love to connect with you, to chat with you, to explore how we can help you. We've got some wonderful realtors all throughout the country that we are working with on a regular basis to help more of their clients creatively create solutions. Jordan is incredible at putting the puzzle pieces together because every transaction is really a puzzle, and it's figuring out the best way to fit those puzzle pieces together, whether or not you have someone who's been denied elsewhere or even someone who's been approved elsewhere. In many cases, Jordan can put them in a better financial solution by looking creatively at the pieces and how those fit together. So our contact information is on the screen. There's also QR codes on the screen. The one top right will give you some information about our dual license program. Some of you who are licensed real estate agents may want to explore getting licensed on the mortgage side and adding that, or actually the opportunity to add multiple mortgage-based revenue streams to your business. And bottom left is where you can send a client or yourself if you want to create an account and apply to have us explore or shop for options for you or your client. If you have questions that maybe were more specific that you wanted to chat directly with one of us on, certainly you can do that here. If you didn't feel comfortable posting it in the chat, totally get that. We'd be happy to chat and explore and see what we can do for you. As I mentioned a couple of times throughout this session, immediately after this is over, the entire presentation will be available on demand at the link that led you to this today. We'll also get the replay added to our YouTube channel, Wake Up Real Estate, and as well to our site at wakeup.realestate, wakeup.realestate, or you can just reach out to either of us and we'll get you the link to check it out. Jordan, any final words of wisdom as far as FHA financing or anything for that matter for the group here?
It should be your favorite loan by far.
Yep, amen to that.
As a realtor, you'll sell the
Yep.
most houses if you can understand the product. So
sorry, I have a call coming up with a TikTok conversation that I was having. I was trying to let them know that I'm just wrapping up our Zoom here. So TikTok playing in the background there. Jordan, as always, thank you for your expertise and your willingness to share and your knowledge. And thank you to all of those of you who were on here and asking great questions and providing great feedback. We look forward to the opportunity of exploring how we might help you. And we will be back next week, Tuesday, 1 Eastern, with another mortgage or financing based topic and deep dive session for those that are interested. Thank you. Take care.
Thanks, guys.
And
Bye.
talk again soon.